Check stocks just past 12 noon in the East. See what we're doing today. We're down, as you see, about 260-ish, between 250, 260 on the Dow, 32.9. We're down 0.75% on the S&P, down a little more than 1% on the NASDAQ, and we're at 411, the 10-year note yield. So we got no red wave as expected. You got Musk selling 4 million Tesla shares. We've talked about that stock, Joe, at critical levels. You got ARK at a new 52-week low. You got Bitcoin at the lowest level in 2 years. And all of that, we pay attention to the CPI, which is looming tomorrow.
Does the calendar say 2023 yet? Because I can't wait for 2022 to be over, because what can go wrong will go wrong. You had a gridlock rally yesterday. That gets met by this negative market sentiment surrounding what's going on in crypto. It's bleeding into the market again today.
Oh, you think that's what this is about?
Without question. Without question. This is, quote unquote, liquidity concerns. Do I think it's, a risk to financial market stability? No, but I do think that people are looking at what's going on right now in crypto. They're questioning whether the liquidity ultimately is going to be there. Who's the last player in this game of musical chairs of bailing out one crypto player to the next? And they're raising some cash levels. And that's just where we are in 2022, unfortunately. And again, I go back to the mega caps. Where are the mega caps today? Mega caps are down. Apple's down below 137 at this point. Amazon's down. Alphabet's down. Microsoft's down. That's going to impact the overall index.
Been watching Tesla, as I mentioned, again, with some calls like Mark Newton made yesterday that the stock could go down maybe just north of $100 to like 109. Liz, how do you see it? Is this about crypto? Is this about not as big of a midterm win, if you want to call it that, as was expected, or what?
Well, first of all, the expectation is usually that after a midterm election, I know Joe will tell you this, after a midterm election, the market usually sighs relief and finds some upside. I'm afraid to say this with Belski looking right at me, but the rally that we've seen up until this point hasn't really made a lot of sense. And what I mean by that is the optimism that I think the market had, whether it was because of some kind of pending Fed pivot, which isn't coming, because of economic strength that I think is waning. Now we're in the face of not only a crypto disaster, but announcements that just continue to pile on to one another about layoffs from tech companies. That eventually is going to bleed into the labor market in the actual numbers. So we're just starting to get these hints of earnings contractions and economic contractions that I think the market has to really right-size itself before we can get to the other side. So a little pullback here, I think, is rational. I don't know that it's going to be the big one. I do still expect one big flush before we are done with this bear market.
All right. So we have like an electric fence around you guys for the Bears.
Batman, I mean, the Bulls. Over there.
The Bulls are in an electric fence, so they can't get close to you. You can say whatever you want. Don't worry.
As long as we're not in the penalty box.
Not yet. Well,
not yet.
I mean, so you do have, I guess some, I don't know if concerns is too strong of a word. I mean, it's not that strong about Bitcoin and the crypto fallout in other asset classes, or, where the roaches are running all over the place, right, that we're going to soon take a look at. The midterm fallout, you've got yields, ARK. What do we think is going on here in the market?
I think it's a whole lot of that, everything. And the four horsemen of the apocalypse that we talked about with respect to the market did a really good job taking out the ARK stocks, taking out the memes, taking out the SPACs, and now it's still going one more time at crypto. And I do agree with Joe. I think it is a liquidity issue. And you take a look at the biggest stocks, they're the ones that are taking on the most water. But those are also long duration assets, too. So the longer duration assets still have a lot of risk to them. And as the market over the next few years, and we've been using this term, normalizes, where interest rates normalize, earnings growth normalizes, and, oh, by the way, the balance sheet normalizes as well, these longer-term duration assets are still going to be under pressure. So it doesn't mean that we're not bullish. It just means that I think we have to be a little bit more tempered in how we're looking at the next 6 months. Now,
are you looking in the mirror when you're saying that, or who's we?
Listen, I have a great team, so I always say we. I don't like to say I, but we.
I like it better when you say I.
So I think this.
You want to do a tag team here? We're going to do a tag team.
So Jim and I think this. No, I think this. There's so much bearishness out there. I had a meeting with a very big account yesterday, and they basically said, yeah, we agree that everyone's bearish. I think there's this pent-up demand for any kind of good news, Scott. And we are.
Well, that's true for sure.
I think the market is a little skittish heading into tomorrow as well, because fool me once, shame on you. Fool me twice, shame on me. Once, twice, three times a lady. Yep. If this thing comes in hot tomorrow, look out.
Well, let me tell you something. I mean, there's a note from a trading desk making the rounds that suggest a hotter than expected report tomorrow could mean a really big decline tomorrow in stocks.
Well, everyone's been looking.
Not your garden variety, 1 or 2% decline either.
Right. So everyone's been looking for this blessed capitulation, right? Maybe that's your capitulation if you see a really hot CPI tomorrow. Then that would actually be good news. Let's wash the deck. Let's have the Fed.
I don't know. Do you think that'd be good news? Because that then brings a much larger than expected rate hike in December into play.
Well, I think the Fed needs to be clear and just come out and say, we're going to 5%. Let's go to 5%. Let's get this thing done and then move on from here and then start the process of normalizing. And I think that's what they've been trying to do, but they need to be a little bit more forceful in terms of this path to normalization.